You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Alan Dunne and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Now, if you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to some of the past episodes that you may have missed, like last week's episode with Rich, where he discussed the topic of uncertainty and the role it plays within the trend-following world. Also, I would like to really encourage you to listen to the midweek episode where Kevin was joined by David Rubenstein, and where I think we heard a rare and quite personal side of Mr. Rubenstein and what he has learned from all of his conversations that he's had with some of the most successful investors in the world, and of course his long career at Carlyle. And of course, not least, you should really listen to the extra episodes that Alan and I have done with the largest CTA firms in the world, and where we are essentially, I think, for the first time, taking the pulse of all these managers, more or less at the same time, covering a wide range of topics that are relevant for the firms themselves, but also for the industry as a whole. And there is much more to come in this series. Speaking of Alan, it's good to have you with me today. And how are things in Dublin?
Things are good. Yeah, I'm well. Good to speak to you again. We've done a lot of podcasts in the last while, but it's all been great.
Yeah, it's almost like a daily occurrence. But today will be different, of course, because we're back in our usual strive with a little bit of current content and some really good topics. We hope that people will enjoy. But because I have had a pretty hectic traveling schedule this week, I was thinking of doing something slightly different from what we normally do in terms of a market wrap, because I haven't really followed what's been going on. I'm sure there's a lot that's been going on. I thought maybe today you and I could just perhaps discuss some of the bigger global macro issues or observations that we both have, and use that as a little bit of a jumping board for our conversation. So if you don't mind, I would love to hear what's been on your radar, or what is on your radar right now in terms of the bigger issues, which of course will also have an effect on the markets as we see them, and therefore also have an effect on the performance of trend followers, of course. But let's take it one step at a time, maybe.
Yeah, sure. I think it is, as ever, at a very interesting juncture. I would say, in terms of macro themes, the first one, obviously, the big focus is, I guess, the economic outlook and the unfolding slowdown that we're seeing. Particularly in the US economy, but kind of the patchy nature of the slowdown, and people, it seems like the market is very much grappling with well, how bad is it, and very much conflicting signals. So obviously we had GDP numbers out this week that were reasonably good, but we've had weakness in leading indicators, weakness in the ISM services sector, obviously ongoing weakness in the housing market. But at the same time, the labour market is holding up pretty well. I think jobless claims have been pretty low, and obviously the unemployment rate stays low. So there's this, question of, I think the consensus is probably for a kind of a moderate slowdown, but it remains to be seen whether it'll be that or worse. Obviously monetary policy comes with a lag. So I think that's one big theme. I think a second one is, we've had a mild winter here in Europe, obviously. So Europe seems to have dodged a bullet, really, in terms of the impact of weather on the energy markets. And I think there's a sense of much more optimism around Europe. If you look at European equities, up probably about 10% on the month. So certainly that's an emerging theme as well. I think, to the background, a big theme influencing markets is this disinflation story. Obviously the last kind of 3 certainly 2 or 3 inflation numbers in the US on the CPI have been better than expected, and not just the headlines coming down, the core is coming down, and then if you look into the details, it's the housing component which is a lagged measure that's kind of keeping inflation elevated. So there's a strong sense of disinflation, but then again a question as to, okay, it's heading in the right way, but is it going to get down to target, or will it prove to be sticky? So I think that's another theme. And then related to that, obviously, we've got China reopening. Obviously, going back a few months, we had China very much in lockdown, and due to a kind of change in approach from the ruling party, a very sharp reopening. So we're in the midst of a reopening phase in China, which I think is also shaping the economic the optimism that maybe the global economy might be able to pull through if we get kind of a spurt of growth from China. I mean, it's not obvious to me, is China reopening? Is it inflationary or disinflationary? It's obviously China reopening is good on the production side, but on the in terms of easing supply chains. But obviously, you bring in an incremental buyer, particularly in commodity markets. So I think there's 2 sides of it there with China opening, and a couple of other themes I think are important. The debt ceiling is obviously back in focus in the US. It feels like every 2 years you get this crazy suggestion about minting the $1 trillion coin, and you have to kind of look up to see where did this come from. But it's the whole point that the US has this process of setting a limit on the amount of debt they can have, and every couple of years they have to have a renegotiation between the Republicans and Democrats. And I suppose what's worried people this time is, there's even more acrimony in Congress, and so there's this suggestion, obviously a concern, I think, that these deliberations and negotiations could be even longer than normal, and we could be back to a 2011 type scenario where a genuine fear of default or a US downgrade again. So I think that's another kind of macro theme. A final one I'll just throw in, which I think is also part of the mix as well, is that I think it got a little bit overlooked when it came out first, and that was the US Inflation Reduction Act that Biden brought in. It didn't seem to be very focused on reducing inflation, but one thing it did do is provide a lot of incentives for the production of green energy projects, and for incentives around buying EVs and producing them in the US, and that seems to have generated a lot of planned investment, and even for European companies to re-domicile some of their plants to the US. And now we're starting to see a concern in Europe around this, and a potential reaction from the European side too. So it is something that we've talked about before, that this greening of the global economy is going to have to take a lot of investment, and that could be inflationary as well over time. But actually, we're starting to see, in the news flow, a bit more tangible signs that that's starting to kick in now. So I think that could be one of the reasons why we are seeing strength in the kind of the material stocks and things like that, even in the face of this kind of widespread expectation of recession. So that was kind of my list of kind of main macro themes digesting at the moment. I think, if you were to sum it all up, I think markets have gone from being very pessimistic, probably like September, October last year, around stagflation, and have downgraded stagflation risk in the last number of months, and increased the likelihood of a softer landing, maybe even a return to Goldilocks. But whether that proves to be correct or not, I'm not sure. I'm still very focused on the fact that we've had a big shift in monetary policy, and that often impacts the economy with a lag. So who knows when we're going to see the full economic impact of higher rates.
Yeah, I mean, it's a great list, and many of the topics was not even on my list, but I think there is some commonality for sure. I mean, if I was going to sum up what's sort of how a lot of these things relate to the markets, I would say that it feels to me like the markets are pricing for some kind of perfection, that we somehow magically, get around a lot of these issues, and and we have this kind of soft landing, rates will go down later in the year, et cetera, et cetera. But I think you said something that's very, very important in dealing with all of this, because there's no doubt that government plays a much bigger role in how we will come through this period. And you mentioned the point about, well, can they even agree? And I actually think that's a really important point, because when you have crises, then there is obviously a need for people to work together and to essentially find solutions across the aisle, if we look at the American system. But it doesn't strike me as if there is that will to work together in many countries, frankly, to find these solutions. So I'm concerned about whether we can, whether this perfect picture that the markets are laying out ahead of itself might get derailed just from the lack of cooperation between policy makers. So I think that's a very interesting point. I also think that, are the markets really listening to what the ECB is saying? For example, they're not saying anything about lower interest rates anytime soon. I'm not so sure even the Fed is saying anything about. They might say, well, we're slowing down, but I don't think they're saying anything about lower interest rates anytime soon. So I think there's there's actually building up a fair amount of risk of disappointment in the markets, both in bonds and in equities. And just based on my own kind of observations, having been involved in markets for 35 plus years, I'm not so sure that what we saw last year was the bottom of the bear market. I think what we're seeing now could as easily just be a big correction in a much bigger bear market, where essentially disappointment with earnings. We're obviously seeing layoffs hitting as well, but disappointment with earnings or whatever it might be could easily change change sentiment once more. So that's sort of some of those things. I also think about the inflation front. I was talking to one of my friends in Denmark the other day, and as he was saying, yeah, it's great that inflation is coming down, but it's still 9%. You're thinking, oh, shoot, it's 9%. And interest rates are far below that. So, yeah, it's going to take some time for it to get down to something like, 4%. And so at the moment, you're hoping that inflation will come down to interest rates, but at some point, maybe interest rates have to come up to the inflation rate to kind of get to that point. And then there's a kind of at least for us here in Europe, another thing I think we can't ignore, and that's the fact that the US and Europe are now sending tanks to Ukraine. What does that mean? Does it mean that Russia at some point will say, well, actually, we can cut half of our oil exports, and so you're going to get 4 million barrels less than you normally get. So that's just probably going to drive up prices by a significant amount, so that they won't necessarily financially lose out too much, but inflation is going to come back on the agenda, that's for sure. The same with, and I'm kind of, I hear from many different people, and some of them obviously guests on the podcast, about some of these constraints that you have in the commodity space, not least with some of the metals. And I'm thinking, I don't know if people are aware of it, but a lot of the metals that goes into production of weapons and the shells they fire thousands of every single day, all of that metal, a lot of it comes from Russia. I mean, it's not like we have metals all around the world. And so that's another thing I'm kind of worried about, is that maybe there comes a time where we just simply can't get the metals we need. And I've certainly heard Peter Zion talk about that companies like Airbus is going to run out of the metals they need to build the planes in the not too distant future. So I have all these different conflicting kind of messages in my mind, which suggests that there's a lot of uncertainty ahead of us, and therefore I'm a little bit surprised about the calmness. I mean, VIX is very subdued. And of course, there has been some pretty big market moves this month so far. But still, it all looks a little bit too rosy for me if I was going to...
Yeah. Well, I know. I mean, it's interesting. If you go back to maybe last August and Jackson Hole, and we talked about it at the time, when all the themes that came out of there were all around supply side challenges that we we will have going forward. And we heard the same from Bill White when we had him on. And anybody who's looked at that side is saying, we've got deglobalization, we have nearshoring or friendshoring or whatever you want to call it, and you've got all of these structural shifts. I suppose the thing about the supply side is it evolves slowly. It's not like there's a monthly release like you have with payrolls or inflation highlighting where we're at with supply side. So it's still there in the background, but it just hasn't been to the fore in the last few months, and the market seems to have pushed it aside as an issue and more focused on the favorable news we've been seeing on the inflation side recently, I guess. But I agree with you. I mean, none of these issues have gone away.
Yeah, and favorable on the inflation side when you exclude food and energy, which is very hard to exclude if you're a family of 4 or 5. So we'll see. I think PCE comes out this week, doesn't it? And so
I think it was out earlier today, but I haven't had a chance to look at it.
Okay, well, neither have I. So good stuff. All right, well, no doubt there'll be more to talk about as we move forward. In terms of a trend following update, sure, there's been some corrections in some of the trends in January. Maybe it already started in December, so there was a bit of dispersion in returns in December. And I think some of the managers who probably lost a little bit of ground in December, I think they're doing somewhat better this month compared to the managers who had kind of kept the positions on during December and therefore benefited from some of the longer term trends resuming for a little while, and now they're certainly been turned in January. So so there's going to be some more pain for those managers, either through the markets they trade or the timeframes they use. But of course, things like bonds and stuff like that has had a good month, and that's against the longer term downtrend that they were in last year. But it's not bad. I mean, overall for the industry, it's not really that bad at all. I was looking at the numbers as of Wednesday night, since we're recording a day early, and the Beta 50 index is down like 20 basis points, so nothing to write home about. SocGen CTA index down about 1%, trend index down about 1.7%. The short-term traders index is flat, slightly down. So nothing at all really to be concerned about. And also my trend barometer is last reading was 45. That's completely neutral. So plus minus a couple of percent for the indices is what it looks like, even though we have a couple of days left for trading in January. And that is, of course, in contrast to, as you were pointing out, equities doing really well this year. MSCI up 6 3/4. Even the World Government Bond Index is up this month, up 2.5% or thereabouts, and the S&P 500 down. Up 5.75%. All right. So with that out of the way, that allows us a little bit of extra time this week to talk about some other topics, and you were very kindly provided some as I have been on the road. So happy to let you lead current markets and asset allocation. Obviously, we talked a little about some of the themes that's going on right now, but where do you want to go with kind of markets and asset allocation? Yeah,
I mean, I think really, we touched on it a little bit in the intro, but we're at an interesting juncture. We've had all of this pessimism in the last year, a big sell-off in equities, and now, as you've said, a big rebound. And so it's kind of like, is that it? Have we seen the bottom or not? And Jeremy Grantham had an update piece out recently, which I kind of thought summarized it quite well. Some of the issues. Obviously, a year ago, he published his piece kind of saying he thought markets were ripe. Obviously, he's been saying it for a while, but he kind of came out in January saying he felt that timing was good then and was pretty accurate with that call. But obviously, we've had the rebound, and now the question is, is it still looking bearish? And overall, in his piece, he was still pessimistic, but I would say a bit more cautious. One reason for the caution is that there is a bit more pessimism generally, like he did highlight how some of the sell side strategists in Morgan Stanley and Goldman are calling for kind of earnings recessions this year. So being a contrarian, that's maybe a concern. The second thing which I found very interesting, and he does often talking about this, is the presidential cycle. He's looked at this historically, and the presidential cycle being at how, where you are in the 4-year electoral cycle can influence economic policy. And actually, what he's found is the period in the second year of the 4-year cycle, from October to April, has been historically very positive for the equity market. Now, I think I'd have to check, but something like the return you get in that period is equal to the return you get in all of the other period, which is statistically very unlikely. I don't know if this is something that any of our managers have ever looked into, and whether the sample size is big enough. Probably not to have any conviction in it. I'm a bit skeptical, I have to say. It seems odd that that period in the second year is so critical. You would have thought maybe a little bit closer to the election would be the time you'd see this boost. But anyway, that we're in the midst of that period now, so it's not.
But if I can interject here a little bit, Alan, I mean, it could have nothing to do with the presidential cycle. It could just be a 4-year cycle, and where it just happens to be we're in that time where market, because I actually personally, if I take off my trend following hat, I think markets do have cycles. I completely believe that. But whether you can pin it to a president or not, I don't really know, but probably I would doubt it, frankly. But is there a 4-year cycle, or is there a 40-year interest rate cycle? I truly believe there is. So it's an interesting thing, and I think, and we'll come to this in a little later when we talk about some of the early observations we've done in the CTA Mini series. But I do think that some managers talks about doing seasonality and stuff like that. So
yeah,
maybe.
I mean, one of the interesting features of it is it's good for the US equity market, but historically it's been even better for the UK equity market. So why that's the case, I'm not sure, but maybe it's just could just be random, but that's one of the factors, and obviously he does touch on the kind of the other parts of the bullish narrative at the moment: China reopening, inflation coming down, etc. But equally, and he touched on it in his piece, is the issue that we were talking about earlier about these periodic shortages that we're likely to see going forward in relation to the metals required as part of the greening of the global economy. And also, and it's something that I wrote a piece in December around as well, about the long and variable lags from monetary policy. We have had this excess cash in the system that, everybody saved during the pandemic, and you had stimulus checks. So money supply growth was unusually high, and money supply growth has collapsed. But the stock of money, the stock of savings, are still in the economy and gradually being depleted. So that's one reason why monetary policy may not to date have been that effective, but you could have a scenario that in the second half of this year, as those savings get depleted, that the higher rates start to have a bigger impact on the economy. So his baseline case is still looking for S&P to go back down to about 3,200 and slightly below, and that would bring it, in line. It would be about a 45 to 50% correction, I think, in real terms overall, which would be in line with kind of past similar episodes. The other point that he does make, which I think is a good point too, because as you say, we've been hearing about, is our central banks going to pivot, etc. And obviously everybody kind of assumes that once the Fed pivots, that will be great for the equity market. But obviously there have been instances in the past, in 2007, 2008, 2002, and other ones where the Fed did start a rate cutting cycle, but the economic downturn was so severe that wasn't enough to save the equity market as well. So I think that's another factor that people are kind of not acknowledging amid all of this expectation about an eventual Fed pivot and how that would save the market. So yeah, just it's another perspective to add to the mix. I thought it did summarize quite nicely the kind of the current bullish narrative, but also put in context the kind of the relevant factors that may still be headwinds for equities going forward.
Yeah, I'm pretty sure I've seen charts floating around in social media land where they show that actually often equity markets, go into or continue a bear market like 9-12 months after the central bank starts to lower rates, which speaks to your point that it may not be a great sign for equity investors, the fact that the central bank is going to change course. The other thing I was thinking about when you talked about the money supply, I mean, the other thing I don't think we can completely ignore is the fact that, the Federal Reserve is tightening and reducing its balance sheet. I mean, I think we're below 8 trillion for the first time since whenever. And although I don't follow it super, super close, but I think the pace is pretty healthy in terms of what's happening on that front at the moment. And that probably has an impact as well. And then I still think another thing we haven't even talked about, but that could also be a little bit of a dark horse here, which I guess our friend Cliff Asness has raised, and that's private equity. I mean, if equity markets don't really kind of recover, and we still have another leg down, for example, at what point do these funds have to mark to market, so to speak? How long can they continue to have their own set of prices, if I can be so blunt to say it like that? It's something that I think we can't completely ignore as a little bit of a risk factor. But I don't know if that's something you come across.
Yeah, I mean, it's been an ongoing topic of discussion in terms of, I guess, in our industry, that we look at it with a little bit of frustration. But I mean, I think there's a sense in some of these investments that because there hasn't been transactions, you don't mark the book yet. So it's a bit of a sense of make believe that okay, nothing to see here, but in reality, everybody knows that the valuations have to be a lot less. Particularly, obviously, in the venture world. Obviously, look at ARC, Cathy Wood's portfolio. That's telling you that these high growth stocks and the most speculative end have adjusted massively in terms of value. So, I mean, what it means, obviously one thing that it often means for our industry is that rebalancing as investors need liquidity. Sometimes the ATM is also is often the CTA. So not always a positive when other assets aren't doing as well for CTAs. But I think it will be interesting to see what's the investment impact, on investor groups like pension funds, etc. What does that do to their asset allocation? They may still have commitments, so they may still have to fund. But I imagine it's probably also for people in the space, there's probably interesting opportunities in the secondaries market now because of all of this. But I'm not close enough to that to be able to speak on that.
Now, the next sort of topic you had slotted in was relating to our own wonderful industry, CTAs. There are a couple of papers, 3 papers you wanted to discuss. I can safely say I'm not entirely sure I've read any of them. I may have skimmed over some of them. So I will follow along as best I can, but it does relate to obviously the CTA industry and so on and so forth. So why don't you set the stage?
Sure. Yeah. Now some of it is in relation to last year, and obviously we're getting towards the end of January, so it's probably the last chance to start to reflect back on 2022 again. But there was a couple of interesting observations. First one was just a paper from SocGen where they do a kind of an annual review, and we're at that point where a lot of firms are issuing their annual letters and probably just have them out by now. But there was a couple of interesting bits in the in the SocGen piece. Obviously, they were reflecting on it being the best year ever for the SocGen CTA index, up 20%, and the SocGen trend also up 27%, its best year. But interestingly, how volatility for the index wasn't higher, so better in terms of risk-adjusted performance. The short-term traders index has also had a very good year, up 11%, and actually you could say short-term did even better. Purely from the perspective that the volatility of that index is very low, only 4.5% vol. So I mean, to say it was better, you'd have had to levered up your portfolio of short-term managers. But it is interesting, and it is something that came up with in one of our conversations recently, how one of the managers had their non-trend had done even better than trend. So it just speaks to what an interesting market environment it was last year, that not only did markets trend, but there was volatility that could be captured by shorter term systems as well. And then in the SocGen piece, they have a heat map of the individual markets and how different trend strategies of different lookbacks performed, which I always find interesting and really shows you kind of how well or not you might have done depending on how you allocated risk. And basically what it shows is, for medium to long-term trend following, bonds were universally positive to trade. Actually, when you look into the commodity space, a lot of the markets weren't that great. If you look at things like sugar and live cattle and lean hogs, for a lot of the time frames, you're seeing their heat map is blue for tough performance, red for profitable, and there's plenty of blue in the kind of the commodity and in the equity space, particularly in the equities for slower systems. So it is interesting if you look at the performance in the industry. We're talking about how 2022 was such a great year, but actually for some managers, 2021 was an even better year, and I think that's because in some of the commodity markets, there were even better opportunities in 2021 than in 2022. So depending on how you allocated your risk, I think the very best market I think was the euro-dollar market, the 3-month euro-dollar future, and that's an interesting one because I think in that market, and we've been talking about this as well, not only did you have a great trend, but you had this huge volatility expansion. If you think about it, going back 1 to 2 years, there was very little volatility in short-term interest rates. So if you got onto that trend early, you would have had a very large position. And obviously, if you weren't a manager that was, volatilizing your position, you would have held that, and it would have been an enormous contributor to performance. So that makes sense that how well, Eurodollars, Euribor's slightly behind, but still very positive. But then obviously Japan 3-month hasn't really moved yet. So I'm sure a lot of people are looking at that as the next possible big opportunities, but we'll have to see if that plays out. But yeah, interesting that, as I say, fixed income, it was really the standout. Currency is good too, but more mixed then across, I would say, the commodities and equity side. And generally in terms of the speeds, obviously, kind of the sweet spot seemed to be in terms of their look backs, kind of between 80 to 120 day look backs seem to be where they found things to be the strongest.
Yeah, no, it is an interesting chart they show about this. Now, correct me if I'm wrong here, Alan, but I think this is based on their trend indicator, right? This is what they base this on. And as you know, it may well have had a good year last year, but the trend indicator that they publish is not.
Yeah, well, no, I think the trend indicator is just one system. So I think that's just. So I think that like this is showing all of different look backs. So it's not just one. Yeah.
Different lookbacks, exactly, yeah. And so on that note, we also ran our kind of where we look at a whole portfolio of markets, where we don't look market by market, but at a whole portfolio of 60 different markets to see where the best, quote-unquote, best look-back period would have been last year. And it was actually pretty close to what I would say is the long-term sort of cluster, which is around 200 days. It was the very best one was a little bit above 200 days. But if I look at the look-back periods all the way down to 20 days, all the way up to 300 days, which we do in our calculations, all of those periods actually would have been profitable last year. So it's not surprising that, well, of course, I would say that short-term trend following shouldn't really be profitable because short-term, you don't really do trend following the way you and I think of trend following. When you're a short-term manager, you do other stuff. You time-based exits. You use all sorts of other ways of getting out. You don't wait for the trend to turn per se. Last year, actually, you would also have made money from a trend following system using shorter-term time frames. So it was a very broad-based trend year. But I agree with you. I mean, again, and that's what shows the difference in how managers put these things together, which you and I are learning during our conversations with these firms, because even though we're talking about the same topics, the way they explain it, the way they tell about their own kind of approach to this, you can tell there's a difference. You can tell that they don't necessarily see the same things, and that's great in many ways. But yeah, I mean, a good year last year without a doubt, and maybe we can't keep talking about 2022, but we will try a little bit longer as we go through our final however many recordings we still have to do. But yeah, and then you wanted to talk about another paper.
Yeah, it was very much on the same theme, to be honest. They published on their website kind of a review of 2022, kind of like the key points, I think, from their letter. And again, they take a similar approach in terms of looking at different speeds, how they did in different markets, etc. And, kind of a similar outcome there, I would say, in terms of in their models, I think they run at eight different speeds, from kind of 5-day look backs to over 120 days. And again, slow was very profitable in bonds, also in energies and in interest rates. Not so in equities, and not so in the credit. They have as a distinct asset class too. And agricultural commodities was a very kind of flat year too, across the different time periods, which is kind of consistent with what we were seeing in the SocGen heat map. The other thing that I found interesting in this paper was that they talk not only about trend, but they also talk about some of the other systematic investment styles and models that they have, such as carry, flows, macro fundamentals, seasonality, as we were talking about, sentiment, slope curve, technical value. And they looked at how all of these types of systems did in the different sectors last year. So that was quite interesting in the sense that, you might have thought, well, it was a tough year, say, for carry strategies. You might have thought with a rising rate, but actually what they found, it was actually positive for carry across the asset classes, negative in some of them, but say positive in things like equities, for example. So like, what's carry in equities? Well, obviously when rates rise and rates are higher than dividends, basically, the carry position in equities is to be short equity. So, there's lots of, we were talking about this there now at our own year-end review, is it the end of carry or not? But you have different manifestations of carry. And obviously in currencies, carry, the dollar was a carry trade last year as well. So interesting that momentum and trend was their best system. But other things did work. Carry, seasonality worked well for them, sentiment. And again, just highlighting that it wasn't just trend, is what we've been hearing from some managers, that trend and other strategies have benefited from this more, I suppose, dislocated market environment.
Yeah, no, absolutely. Completely agree with all of that.
Maybe we move on to the next topic, which kind of feeds into what you were talking about just a moment ago, and that's this whole issue of speed. And Man actually had a paper out on this earlier this month, looking at the topic that you're talking about, which is fast trend following and the benefit or not in a portfolio. What the paper presented was basically what you get by adding faster trend systems to a portfolio, or if you look at the performance of fast trend systems versus slow trend systems, in terms of, now they do break it out in terms of before cost and after cost, and as you highlighted, the cost is obviously very significant when it comes to short-term trading, because you're trading so frequently. So on a kind of pre-cost or before-cost basis, even not allowing for cost, fast trend hasn't done as well as kind of medium to long-term trend, but it did have a more favorable, a positive skewness. So kind of different risk characteristic. So what's the benefit of it? So tangibly, the benefit is, particularly in times of equity downturns, that the faster trend systems will do better. So that's one of the things. You get this favorable skewness, better performance in equity down markets. But obviously, what's critical to being able to capitalize on that is having good execution, and obviously this is a theme that we've picked up from the managers too. What was interesting within their paper was they then looked at how, if you combined a trend system with a 60-40 portfolio, even after cost, which trend system would give you the best kind of drawdown mitigation for the overall portfolio, but between 60-40 plus trend. And they found that an equally balanced or equally blended one across different speeds. So having some faster systems was favorable in terms of mitigating the drawdowns in equities, whereas if you were reliant just on slow trend, you would suffer a larger drawdown. So I thought it's an interesting paper. It's very much, I think it's a good segue into picking up on some of the themes. Because really, when you think about it, it strikes me that this is the kind of the journey in the CTA world. You want to generate absolute return, so that argues in favor of medium to long-term trend. Then you have to confront the fact that you'll have drawdowns and they can be painful. So then people say, well, will we add some carry or something like that or not? And then you've got the fact that people are looking at CTAs for crisis alpha. So you want to be able to deliver some kind of performance when equities turn down. So that argues in favor of, well, maybe should we add some fast systems or not? And everybody's kind of grappling with all of these questions, and people have come to different conclusions, reflecting different utilities, to use that expression, or different tolerances for drawdown. But I think that's kind of broadly the journey and the trade-offs that people are experiencing as they kind of construct trend following programs.
Yeah, no, I completely agree. It's been fascinating to learn about how people look at these things, but then also have to put it in a business context, right? They have a business to run, and they have clients to. Well, some people might say, well, it shouldn't be the clients who decide what systems we use. We should develop the best system. But many people would argue, well, that doesn't help if the clients can't stomach it. So there are lots of things you have to take into consideration. I think that's also been, and maybe we're halfway through our recording so far, Alan, and I can't really think of two firms so far that have given us kind of the same explanation. They've all been a little bit different how they've interpreted this and how they've designed their strategy so far, which is quite fascinating. And feel free to go back and talk about some of the points you wanted to raise. But there's one thing that's kind of still on my mind as we kind of get through this these conversations. And maybe we need to raise that more in the conversations we have left to record. And that is, well, how does it still leave the industry in terms of compelling investors, more investors, I should say, to implement this? Because I know part of the topics we discuss and that you kind of bring up is this the role of trend following in a multi-asset portfolio. But maybe we need to try and dig a little bit deeper into how the various firms try and get more people to take the step. I still think that's it's a big question mark for me still after all these years as to why it is so hard for investors to embrace a strategy that has so much evidence on its side. And okay, maybe it's going to be a little bit easier the next 12 to 18 months to get people to focus on trend following. And certainly I just came back from 4 days in Barcelona with at a conference. And trend following, even though it wasn't a trend following conference, but trend following was on the agenda. It was talked about. Many people raised it as an area where they wanted to have some exposure. etc., etc. But we still need to follow through, right? We can't just say just because it's been a good year and people and it's on the top of the agenda for some people that's enough. It's not. And I still wonder what it takes for people to really embrace and internalize the value that these strategies provide.
Yeah, no, I mean, and that's, as you say, one of the important points that managers have made around making it digestible is, and that's part of the motivation for having not pure trend, but trend with some other strategies to smooth out the return. And also, as some of the managers said, it's a painful ride for the manager if it's pure trend as well. So it's not just purely from the client's perspective. So I think that's definitely valid. It's interesting. It was definitely commented in one of the conversations around people's experience of time and how a 1 year drawdown or a 2 year drawdown doesn't seem like a long time when you look at it on a chart of a historical simulation or whatever. But if you live through it, it can feel like a long time, and it's an interesting one. It's just, I think the randomness of outcomes, as when the returns will arise and arrive, that's the thing that I think people struggle with. So I don't know. It's kind of one of those ones that CTAs capitalize on people's behavioral biases, broadly speaking. But those behavioral biases mean that people are reluctant to allocate to CTAs. So there's an irony to it. But will that change? I don't know.
No, and the other thing, certainly that I'm picking up on from just seeing the data coming out now, but also I think some of the conversations we've had, seen some of the year-end letters the managers have been sharing, is that a little bit counterintuitive when you think about how well this area did or this strategy did compared to anything else last year, right? But it looks like there were quite a lot of outflows from the industry. That's what I'm seeing, at least. And of course, so at first glance, you could say, well, that's weird because people are selling what's making them money. But actually, when you think about, okay, so who's invested in these strategies? It's most institutional money. Then it makes perfect sense because they have to do their quarterly or annual rebalancing. And therefore, they have to sell out of the things that are making money to buy the stuff that is, losing money. The question will be, of course, are we going to see the reverse? If equities are having a great period now, is it then time to sell some of that and then buy into some trend following again, for example? From memory, it never seems to quite happen at the same pace as the other way around, but maybe I'm a little bit too pessimistic here. Perhaps people have learned the lesson and they will be disciplined about that rotation as well. Time will tell. But that was another thing I picked up on. And then, of course, we've also asked them a little bit about how they feel about being replicated, which, of course, I might pick up with Andrew next week when I speak with him. I would say the answers we've had so far, I think, is very, very like what I would expect from people in our industry, because I think they have been very constructive. It's not like they're sitting in the corner being, upset about the fact that someone is trying to replicate what they do. But there have, of course, been different variations of that. And one thing I did pick up on, and I don't know how much I want to go into detail today about it, but one thing I did pick up at this conference that I attended is that there's a lot of focus on trend replication. So some of these investment banks, they must really think that either it's a great strategy and all their clients should have it, even though they're competing with another set of their clients, or they're just seeing an opportunity to make some money because trend is in favor again. I'm not so sure. Even having attended a couple of presentations on how they do their trend following, which, frankly, if I'm being very frank about it, I wasn't impressed, and I thought there was a few shortcuts that I didn't like that they did not disclose in terms of cost and in terms of simulated data rather versus real data and all of that stuff. But it's certainly on the agenda from these big powerhouses. That's for sure. Which you could say all publicity is good publicity, so maybe it is a good thing. We'll see.
Well, just one thing I wanted to touch on to kind of close out was just around obviously, it struck me listening to a lot of the managers. My background's obviously more multi-manager portfolio construction, but actually you face the same challenges as a multi-manager allocator as you do as the single manager. Has the same kind of trade-offs in terms of, okay, let's generate a portfolio, trend focused, but then we got the drawdown consideration. So will we add some non-trend strategies? Could be quant macro, short term, particularly from the perspective of delivering crisis alpha. So I think, just to touch on that, I mean, and equally, one of the topics that came up was that now it's the way the industry is evolving for the institutional investors. At the single manager and at the multi-manager, customization is becoming a much more important thing. So it's not just that managers have one fund and they go and sell it. Instead, they say, well, do you want pure trend, or do you want trend heavy, or do you want multi-strat? And they let the investors decide. And you're seeing that on the multi-manager side as well. So again, you could have clients saying, we'll build out a trend heavy portfolio or build out a diversified managed futures portfolio. Obviously, from a multi-manager perspective, the big case for multi-manager and when you're allocating to CTAs to go with a number of managers is obviously the dispersion that we see across the industry and the low persistence. So I had a look at the managers in SocGen trend index from last year and looked at their performance over the last 10 years and risk adjusted all the managers to 15 vol, and actually the average annual dispersion is about 32%. So in any 12-month period, you would expect a 32% difference between the best manager and the worst manager out of the 10. So that's pretty sizable dispersion. And this is a topic that's come up a bit, and it came up in the context of the replication conversation as well. Like, do investors want to capture the industry return, or do they want to get the best managers? And of course, the challenge is very often what you see with managers is they might have a 1, 2, 3 year period of outperformance, and they attract flows, but then not that they do anything wrong, but they just experience reversion to the mean, and suddenly they underperform, and that can be difficult for an investor to hold. So the basis for considering multi-manager is obviously it's partially behavioral, I would say, in that sense, in that it helps you overcome selling out managers just on the basis of a couple of years underperformance. Obviously, there is a diversification benefit, in the quantitative sense of if you allocate to 10 trend followers, you will get a level of volatility reduction in your portfolio. So you can either choose to have a lower vol portfolio or lever that up. So there is that kind of quantitative benefit too. But I think that behavioral aspect is quite important, and that's kind of been what you often find when you're engaging with investors. So we had a bad experience with managed futures. We went into it once, we picked one manager, then they underperformed, and we exited. So I think looking at multi-manager and that can either be with a fund of funds or doing it. Obviously, large institutions will often do it themselves. You get that benefit, and then obviously what you can do is, as we've been learning, managers take very different choices in how they execute trend following, and because of those differences in choices, you get slightly different return profiles. So with the multi-manager approach, you're obviously blending to get the benefit of all of that in a portfolio. So I think that richness, that dispersion is certainly something that's, and that variety of approaches is certainly something that's coming out quite strongly in the conversations that we're having.
Yeah, no, absolutely. But of course, I mean, there's several sides to this, because of course you could say, well, investors shouldn't really care about whether they're underperforming or outperforming 1 year or 3 years or 5 years. It's a long run. I mean, like, they don't necessarily look too much about, individual stocks on a year-by-year basis. So I take your point, and I agree that there could be some comfort for people to not have to worry so much about that, but they're probably paying for it somewhere. But the other thing you mentioned that I thought was quite interesting is this idea that, because I obviously we've heard it from in some of our conversations, but I also think it's this idea of giving people more choice, right? Saying, well, maybe you can decide whether you want the equity beta being capped and this, that. You can do these building blocks. And on one side, I can see the compelling argument for that. But on the other side, I'm also thinking, no. You don't want to give people all these choices because they're not equipped to make those choices. That's what we are there for. That's what our research is there for. We should put our best ideas into one product, and investors should rely on all the experience and the research, etc. But of course we see that there are different approaches to this as well. So I was just curious where you sat on that, whether you think people should choose themselves or whether they should let the manager with all the experience do the choosing.
I think it is something that has been in my mind as we've been having a conversation, and I think there's kind of two ways. Like you can give people certain things, but not necessarily everything. You know, so if a manager, if a client said, "Oh, we'd rather if you didn't trade dollar yen or something like that," you'd probably push back and say, well, no, that doesn't make sense. You know, I mean, just because a certain market hasn't delivered returns, say, for a number of years, you know, that kind of decision isn't a good choice to make. But if somebody says, okay, I want trend plus non-trend, I think that's fair enough, you know. So I think there are some things you can say, okay, yeah, that's the kind of choice you can offer. I think it's interesting. You kind of have the larger firms who have evolved into these kind of solutions providers, whereas maybe the smaller firms are more, have the trading heritage of the person who started it, and they're still thinking in terms of, okay, what's the single best portfolio to deliver the strongest returns? So I think it's kind of philosophically two different approaches. Can't say one is right or wrong. The only thing is I would say is you do have a duty of not to give people things that wouldn't be good for them in a sense. So in a portfolio sense, you don't want to add like shortfall or something like that. Just, you know, so I think you can give choices, but just you can't give people everything.
Yeah. No, that's fair enough. Now, Alan, we also have to look inward, of course. And I did see, and I think the people or the group of people who hear what I have to say now, they know who they are. But I did see actually on my way back yesterday a comment. He very kindly didn't say which podcast it was, but we're happy to admit it was on our podcast. And I think where he felt that in one of the episodes we haven't been hard enough, we hadn't pushed back enough on some of the statements that were made in the conversation. But all I just wanted to say is that we are not here to call out managers and make them uncomfortable in these conversations. We're here to try and get the best we can out of the conversation. So so even if we don't necessarily fully agree with it, people shouldn't expect us to get into a heated debate about certain things and certainly not comment on their performance, whether it's been good or bad or whatever. So I think the person who wrote that tweet will know who I'm talking to, and I respect the view. And it's not that it hasn't crossed my mind, but I hope he also understands what we're trying to do with this. And as I said, I think what we've done and what we're hopefully what we're doing right now has never been done before. And I think the value of bringing all of these brightest minds in our industry together in a series like this, I think I hope it makes up for the fact that we're not necessarily wanting to get into a heated debate with them, but actually just hear their thoughts. That that's what this series is all about. All right. Any final thoughts, Alan, from you before we wrap up?
No, I agree with you. I mean, I think we can't, like, the idea isn't to get confrontational. It's to give managers the opportunity to answer and give their perspective on these topics. If there's some things that they don't go into in as much detail as some people would like, I can understand it could be a bit frustrating, but at the same time, yeah, we're not here to to try and interrogate or confront people aggressively. So yeah, but yeah.
No, it has to be a safe place for people to come and voice their opinions. I think that's how we get the most out of this, and how we get them back and talk about all of these topics. So we're going to wrap up our conversation today. We hope, as usual, that you've been able to take something away from it, and we would very much like if you would take just a few minutes to head over to iTunes or Spotify or Amazon, wherever you hear your podcast, leave a rating and review. They are coming in on a regular basis, but we could always use more. It's actually one of the things that Apple has come out saying this week, that's what helps their algorithms to put people in higher up in the charts, that people are engaged, that they comment, etc., etc. So if you wouldn't mind, spend a few minutes to do that, we would so much appreciate that. As mentioned earlier, next week I'm joined by Andrew Beer, who's back, our resident CTA replicator. That's going to be fun. Maybe he's got some views on some of the topics we've already touched on with some of the managers. But of course, you can also ask him questions, so feel free to send them to info@toptradersunplugged.com, and we'll do our best to bring them up. From Alan and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.